You clicked on this video because you are wondering if saving for a down payment is the smartest move you can make with your money. You are worried that every month you wait to buy a home, you are throwing your future wealth away. The real stakes here are far higher than a simple choice between renting and buying. You are actually deciding whether to lock your capital into a low-yield asset or let it compound in the market. By the end of this video, you will understand the specific time frame where buying becomes mathematically superior to renting, and you will see why your current savings plan might be costing you a fortune. Let us start by reframing how you view your home buying fund. Most financial advice treats this fund as a goal, a milestone you must reach to unlock the American dream. This perspective is dangerously incomplete because it ignores the concept of opportunity cost. When you aggressively save for a down payment, you are not just accumulating cash, you are actively removing that capital from the market where it could be growing. Every dollar you put into a down payment is a dollar that is no longer earning compound interest in a diversified index fund. This is what researchers at InvestIndex call opportunity cost in hiding. It is a hidden friction cost that erodes your net worth over time. Consider the mechanics of this trade-off. Standard advice tells you that renting is throwing money away because you do not build equity. However, this ignores the fact that your rental payments are an expense, while your down payment is an illiquid asset. The capital tied up in your home equity incurs significant hidden costs that liquid investments do not face. These include property taxes, homeowners insurance, maintenance, and high transaction fees like transfer taxes. These costs eat into your returns, making the net wealth outcome of homeownership often negative compared to a liquid portfolio, especially in the early years. The most critical insight here is that the decision to buy is not about finding the right house. It is about the timing of the purchase relative to your investment horizon. The financial break-even horizon for buying a home is highly nonlinear and depends entirely on your specific location and the local housing market conditions. If you buy a home too soon, the friction costs and the lack of appreciation in the first few years mean you are worse off than if you had rented and invested the down payment. You are essentially paying a premium for illiquidity without receiving the return required to justify that delay. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. To understand why this happens, we must look at the production trade-off. When you focus on saving for a down payment, you are diverting your time and capital from high-growth investment vehicles to a low-yield, high-friction asset class. The engineer in you knows that capital allocation should be optimized for return. Yet, many people treat their home buying fund as a savings account rather than an investment decision. They miss the fact that the same money could be generating significant wealth through compound growth if left in the market. The opportunity cost of locking that capital is the foregone growth of a diversified market index over the years you are saving. This creates a trap where the standard advice to save aggressively becomes a net negative wealth outcome. Unless you buy within a specific time frame or a high appreciation zone, the math simply does not work in your favor. The break-even point is not a fixed number like 10 years. It varies wildly based on local variables such as the Housing Opportunity Index, regional transfer taxes, and specific mortgage rates. In some markets, the break-even horizon might be 20 years or more. In others, it might be shorter. But for many people, the period of negative net worth lasts far longer than they anticipate. Let us look at the specific data that supports this view. Research from InvestIndex guidelines explicitly frames home equity as illiquid capital that incurs significant hidden costs. These studies show that transaction fees and ongoing holding costs can reduce the effective return on a home investment by a substantial margin compared to a stock market index. When you factor in the compound growth that the down payment would have earned, the gap widens significantly. The data suggests that for a typical buyer who saves for 5 years and then buys, the opportunity cost can amount to tens of thousands of dollars in lost wealth over a 30-year period. This is not a theoretical risk. It is a mathematical reality for those who do not calculate the break-even horizon. The solution is not to never buy a home. The solution is to calculate your personal break-even horizon before you start saving. You need to compare the rental savings against the potential appreciation of the home versus the compound growth of the down payment in a diversified asset class. This requires a mathematical comparison rather than relying on general slogans about building equity. If your local market does not offer enough appreciation to outpace the compound growth of the market index, plus the cost of capital, then buying is the wrong move for your financial situation. This shift in perspective changes the entire conversation from which house to buy to whether to buy at all. It reveals that the rent or buy trade-off is fundamentally a comparison of liquid index fund compounding versus illiquid real estate equity. For many beginners, the latter often underperforms the former over 10 to 30-year horizons. The same money and logic used in modern calculators demonstrates that the opportunity cost of locking capital into a down payment is the foregone compound growth of that capital in a diversified market index. This factor is often ignored in standard financial advice, leading to suboptimal wealth outcomes. You must now ask yourself if your specific situation meets the criteria for a positive net outcome. Are you buying in a high appreciation zone? Is your timeline short enough to capture the gains before the friction costs eat them up? Or are you simply following a script that was written for a different market or a different era? The answer to these questions determines whether your home buying fund is a stepping stone to wealth or a trap of delayed compounding. The goal is not to avoid buying forever, but to ensure that when you do buy, you are making a calculated decision that maximizes your net worth, not just your emotional satisfaction. The path forward is to treat your down payment fund as an investment decision, not a savings goal. Calculate the break-even horizon for your specific location and compare it to your expected tenure in the home. If the math does not favor buying, then renting and investing the difference is the superior financial strategy. This approach empowers you to make decisions based on data rather than fear or social pressure. It allows you to build wealth more efficiently while you wait for the right moment to enter the real estate market. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.